In today's trading session, most of my intraday focus was on the S&P. And the whole idea was to be able to buy the ES futures or the SPY as it sunk down to a support level shortly after 10 o'clock and ride it higher. And most of the reason for that was we had already taken out the clearing range high. And then later on, we would actually also take out the initial balance high. And on those days that both these are taken out, this is the high and low between 9:30 and 10, and the high and low between 9:30 and 10:30, we tend to have some pretty decent follow through. Okay, but then we had this little sell-off post the London close, or I should say the London fix, 11 a.m. So what did today ultimately tell us? Today told us that while we may not be dealing with the volatility of yesterday, and while the carry trade concern is definitely on the back burner for now, and why might that be? Well, if you take a look at the yen, it pretty much held steady today. So it's not as if the yen continued to gain on the US dollar. All right. So that stayed pretty steady. But that just brings up a really simple question, and one that I was asking my members this morning. What makes us think that everybody out there has to unwind their carry trade, right? Whether that be Aussie yen to the long side, whether that be dollar yen, what makes folks think that they have to unwind their yen short positions? And the truth of the matter is, there is still, on average, 3 to 4 to 5% interest rate differential between the still very, very low Bank of Japan rate, which is roughly under a quarter point, and the rates of the US, New Zealand, the UK, Australia, Canada. All of these are significantly higher. So the carry trade is not dead. It's just that those traders, and this morning I called them big dumb money, had to unwind their position. And why do I say that? Not to be harsh, but because if less than 0.3% was enough to invalidate the carry, you didn't have a very good carry on to begin with, right? Because the interest rate differential is still massive in the higher yielding central bank rates versus the Bank of Japan. But selling oftentimes can beget more selling. And we had that VIX that spiked up to 37.5 on the VX futures. So here's taking all that into account. What now? What do we do going forward? Today was a pretty good day of at least finding some footing. Today's daily candle on the S&P, let me zoom into that. Today's daily candle on the S&P is what's known as an inside day. Today's range on the S&P futures is inside yesterday's high to low range. Not by much though, but it is. We just were below yesterday's high. So it's a pause candle. It's not a panic candle. And it's the first pause candle we've had in some time. Yesterday's low, all the way down to 51.20, was darn near a 10%, temporary, but 10% correction. There are going to be traders out there who are going to see two very important things that happened yesterday. The VIX spike to 37.5 and a 10% pullback on the S&P, and they're going to have a longer term time horizon. What does that mean? They're not thinking about this week, or next month. They're not thinking about the 50-point basis cut we're likely to get on September 18th. They don't really care where we end the year. But they know that signal of that spike in the VIX, right? And then separately, but importantly, the move of 10% down in the S&P is a 6 to 12 month horizon, meaning if you're willing to hold on to things you buy now, 6 to 12 months from now, they're probably going to be higher. And that's slowly factoring in those two things. Not every ounce, not every dollar, not every yen of the carry has to be closed. Not everyone had a dumb carry trade on. And I say dumb because, again, less than 0.3% unwinds an interest rate differential that can be sometimes north of 4%, and in fact did not, right? But some traders had to unwind their carry. And again, the other thing is that 10% pullback coupled with the 37.5 print, darn near, on the VIX tells us that if we go forward and if we have the patience, which is another way of saying time horizon, this is a buying opportunity. I think a third element, this is more technical, is the fact that we settled on this VWAP here. All right, and none of this is predicated on the fact that likely by December 18, we will get our fourth quarter point rate cut. Half point in September, quarter point in November, quarter point in December. Will be 1 full percentage point or 100 basis points lower on the Fed fund rate. Now, it'll be interesting to see what the Jackson Hole Symposium and the Federal Reserve has in store for us on the 22nd of this month. Well, we're not going to see them until the 18th of next month. But these things are all telling me that it's time to just accept that a certain part of the carry trade had to be unwound. It doesn't mean that we're out of the woods yet. And if we have that longer time horizon, we can use that as a buying opportunity. Because after all, Wall Street's the one place they throw a sale and nobody seems to come. And that's where we sit today, gang. So keep it either very short-term swings, short-term day trades, 1 to 3 days, maybe 2 to 10, or go way long-term and ask yourself, what can I buy today that I can hang on to for the next 6 months minimum or longer? And you're going to put yourself in a really good place to take advantage of what's happening right now. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.